And
Um,
I see it says live.
it says live, yes. Sam, can you check if the other one is live? I don't see the Instagram. I'm clicking on go live and it's not showing. Okay, I see it now. It's popping up. So, all right, it's live on IG as well. All right, Mr. Ham. Okay, welcome everyone. If you're joining us for the first time, this is a live Q&A session. Testing, 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 testing. Almost time. So, all right. We're gonna give everyone like about 5 minutes to join us live, and then we're gonna start at 1. So, welcome if it's the first time. Welcome. Um, okay. Right. A few more minutes to go, and I'll be able to introduce you, Mr. Ham. Okay. Um, okay. Let me make sure my phone is not in the way.
Yeah, I just checked mine too. Don't want it to go off.
Yes, sir. Okay. Okay. All right. I need to take my. This phone needs to be silent. Jeez. Okay. I hope you don't hear the sound anymore. I hope so. I'm trying to set up something on the side here. So, all right, Mr. Ham. 2 more minutes.
Two more.
Yes, sir. 2 more minutes, and we will start. Welcome if you're joining us for the first time. Welcome, welcome, welcome. Yeah. Okay. Okay. Yeah. Okay. A few more seconds to go. and it's time. So, welcome if you're joining us for the first time. Today we have with us here Mr. Ham, Michael Ham with Churchill Mortgage. Welcome, Mr. Ham. Mr.
Thank
Ham
you.
is a home loan specialist. He's a member of Chairman's Club. He proudly serves other states as well: Arizona, Alabama, Arkansas, California, Florida, Georgia, Indiana, Kentucky, Mississippi, Missouri, Ohio, Tennessee, and Virginia. So, if your state is not part of the states I mentioned, Mr. Ham can connect you anyway. So, it doesn't really matter.
That's
But
right.
he serves in all these states and he's very easy to reach. He's one of my lenders when I'm looking for someone to communicate with my clients easily. And he does that excellently well and guides them all through the um, home buying experience. So he's been a lender for 20 years and he's been with Churchill Mortgage for 15 years. He's married, happily married, and he's been married for 30 years to his wife, Amy. And they have two lovely kids, 27 and 25-year-olds.
That's right.
So you're talking to a veteran here. So ask your
This means
questions.
I'm old.
Bring your questions, ask him. Feel free to ask Mr. Ham. And his information is up here on the screen. If you have to reach him personally or privately, please feel free to send in your questions so Mr. Ham can tackle them while we're live. Otherwise, Mr. Ham, the floor is yours, please.
Last well, thank you for having me.
You're
I have
welcome.
to say this is my first time doing a live deal like this, so it's kind of cool. Never done it before. First time for everything. So
Yes,
you managed to get the old guy to do it. So
good.
that's a success. So obviously, open to any questions that anybody might have. Timmy, you did mention, you get a lot of questions about investment properties.
Yes, sir. And one of them is right there on the screen. But before we go into that directly, I mean, I want people to understand that mainly today we're trying to tackle or look into how we can use that what's it called, the potential that you have in your home, that leverage that you have, that you probably are thinking, how do I use or maximize this excess that I have in my house, especially if you bought a home some years ago when the rates were like 2%,
Yes.
3%, and you're thinking, wow, I have a lot to play with or work with here. That's the main thing we're addressing today. So Mr. I'm talk a little bit about that before you go into the question.
No, absolutely. So you know, un- unfortunately, I'm not aware of any options out there to be able to finance an investment property with less than 20% down payment there. So, and in fact, the more, sometimes more down payment, 25 or 30% down payment can make it, obviously even more affordable because you're paying less money, and it can also assist with the interest rate that you get out there. So, yeah, but kind of what you're leaning toward there would be those of us that own a home and have a lot of equity in that home. How can we use that to help buy an investment property
Hmm.
there? And that's kind of the tricky part. That's the hard part because you have to be able to get to that money.
Hmm.
And there's basically two ways that you can obtain for the most part. Well, actually, there's three ways to get to your equity to be able to utilize that money. So one, of course, and what most people do not want to do is you can sell your house
Hmm.
there, and honestly, that's the only way you're going to get 100% of the equity.
Hmm.
There, there's not another way. So, but even if you did financing, for example, a HELOC, which is a home equity line of credit, you can
Mhm.
utilize that as a tool to
Mhm.
access your equity in your home. And generally speaking, most people would do that for their primary home, the one that they live in
Hmm.
there. So, and that is completely legitimate. You can use that a HELOC to get those funds, and you can use that as a down payment to help you buy an investment property, among other things,
Hmm.
if you chose to do that. So, um, with for most HELOCs, it is, and it's not across the board because every bank's can do different things, but I'm personally not aware of any banks right now that will lend more than 90% of what the home is worth, of the appraised value. There, so while you'll be able to get a pretty good chunk of that equity, you're not going to be able to get all of it. There, so but you can totally use that, and that's very legitimate. You can't like put money on a credit card or use a credit card to get cash off of the credit card, and you can't use that for down payment there, but you can use a HELOC money because that money is secured against the home. So that's okay. So yeah, so in most cases, HELOC, the interest rate is tied to the prime rate. And of course, you hear about the Fed talking about raising rates and all that other stuff. Well, that affects all of that. The current prime rate is 8.5%. So you can expect to get at least an 8.5% interest rate on that HELOC. Now, if the Fed does reduce the federal funds rate, then the HELOC rate typically would come down like that does. But you're at the mercy of the market.
Wow. Okay, so what's the third one?
So the third one is just to do a cash out refinance. For example, you have a lot of equity in your primary home, your primary residence. You just do a cash out refinance, and but with that said, you can only, for the standard conventional loan, you can only access 80% of the appraised value when you do that. So you're still leaving 20% equity, which is not a bad thing. It's good to have equity there, but it's you're restricted in how much money or funds you can get to be able to use. Plus, if you do a cash out refinance, you're subject to whatever the market rates are. A lot of people right now have a nice low interest rate, 3 or 4% or even 5%.
Yes.
Out there, but you don't want to take an interest rate that's in the 7s when you already have a really low interest rate. So that's the hard part.
That's the hard part. So you said if they want to get 100% of that equity, that leverage, then they need to sell their house. And so hypothetically, if anybody goes to the market now and they had 3% rate when they bought the previous house, or even, I don't know, and now they want to access that huge chunk they have and they sell their house, then they have to go out there and buy at what, 6%?
Yeah, or higher. Yeah,
higher, which is, so you have to be sure that you can sleep at night to make any of these choices, whether it's the 100% of selling your home, 90% of accessing that HELOC, or 80% of doing a cash out refinance, right?
That's basically right. So there are some exceptions, to that, especially on the HELOC side. But for the most part, that's kind of the general rule, or general guidelines, I should say, not rule.
Okay. Before we go into that question, there's a question that popped up. Can you see it on the screen?
So, yeah. There we go. What are the potential risks and benefits of buying a second home in a popular vacation destination or up and coming area? So, a second home or a vacation home is exactly that. So you're buying it essentially as it's like a second primary residence, if you will. So in other words, you're not buying it for the purpose of renting it out. There, so that's so there's where the cash flow thing comes in. Now, if you have the income in that sense and the wherewithal to do that, then that can be a very good way if you buy a home in a popular area. That can help you to build wealth for sure, because you're going to be gaining the equity in that home, depending on how long you own it, of course, out there. So that but it's not it's not necessarily, it's not going to cash flow. Let me put it to you that way. So in other words, you're not going to be renting it out and getting money back.
So if you were something that the seller, the buyer rather, is able to rent out, and get money back, would that change anything? What would that change?
Well, yes, and at that point in time, if you buy it as an investment property,
Mm-hmm.
there. So now with a second home, you can theoretically, for a conventional loan, you can do as little as 10% down there. But of course, you're not buying it as an investment property. You're buying it as literally a second home. So that's where you live there part of the year. Where if you do the investment home, now you have to have at least 20% down payment on that. But if you can rent it out, then that does give you the option that where you could theoretically cash flow the property, meaning you could make at least as much or more by renting that property out as what your mortgage payment is.
Okay.
And not just your mortgage payment, but also the property taxes and the insurance and the homeowners association, anything else that might be associated with that. That all comes into consideration with that.
So it depends on where you're buying. Because I know, for instance, if you're buying a vacation home in Texas, your mortgage insurance is going to be, sorry, your property tax is going to be really high. So that
Yes.
you can, I see.
There. So, it just depends on the market that you buy in. Can you sustain the taxes and the insurance and the homeowners association? Can you sustain that, make and so that it cash flows, so that you in other words, you make money every month. That's why you would do that.
Okay.
You want to pay for itself and make money on top of that, of course.
Okay. Before we go to this second question, let's look at this. The first question we had before we went live: is it possible to pay less than 20% equity for investment properties? And I
For an
think
investment property,
you
right?
kind of mentioned. So tell us anyway.
Hmm. That I am aware of, no, I'm not aware of any possibilities out there for at least on a conventional loan side up there where you can do less than 20% down payment.
Hmm.
That I suppose maybe it's possible that there might be a private investors if you know somebody, that kind of a thing. But again, I don't know anything about that because I'm not involved in that world there. But as far as obtaining a conventional loan to buy an investment property, you have to have at least 20% down.
Okay, so there you have it. Answer to that, and that's where your your equity in your house can come into play. You can use that if
Yes.
that would be sufficient enough for that purpose. So if you have a house currently and you have enough equity in it and you're looking to invest, um, we're recommending that you look into that
Hmm.
equity you have and leverage that for that 20% you need for the down payment for the new investment home you're looking to buy. And remember, when you buy that house, like he's saying, and you have that plan to lease it out or rent it out, then that cash flow can help you pay off that mortgage over time. So, Mr. Ham, let's look at the next question. Is it advisable to invest in college towns, which is similar to what the first question is, investing in vacation? So, is it advisable to invest in college towns, especially with Tennessee that has a lot of, colleges around?
Absolutely. Uh, I can say this, that I have had several friends that whose children have gone off to college, and they have subsequently bought a home there where they're going to school. And that's where their child lives, and maybe they can rent out a bedroom or two or something like that to roommates, that kind of a thing. But
Smart.
that's what they do. So in that sense, it makes sense. There's all and of course,
That
talking to a really, really good realtor is, the important part in that sense, Timmy, because, you need somebody, you have to be familiar with that particular market. And is it going to, adequately cash flow? In other words, is it a good investment
mm, mm,
there? Because I can only imagine there's going to be certain college towns around the country where it might not be as good of an investment as it might be in other towns. So
true.
you'd have to be very aware of that. But that said, that's, generally speaking, a college town. Yeah, yeah. I mean, there's a high demand for rent.
High demand.
Yeah, because I mean, that's not all colleges have enough dorm rooms to house the students.
True, 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 true. So there you have it. So somewhere like Nashville, Murfreesboro, you look at areas where you have colleges, and if you have kids that are old enough to go to college, like you said, it might be a good idea to have them live in one room rather than pay
Yeah.
for that dorm, live in one room and lease
Yes.
out the other room. So
Yeah.
yes, yes, yes. All right.
Most of the people that I've known have done it exactly that way. They've kind of followed their children where they're going to school, and that's where they'll buy a home, and then after their child is done, they might keep it or they might sell it. It just depends on how it what they want to do with it.
Hmm, smart. Okay. Now the third question before I let you take over completely. In what circumstances is it worth accessing a HELOC?
So I mean, that is in most cases it's going to be a very personal question there because it's going to involve what is your personal situation, what is your how much risk are you comfortable with.
Mm,
So if you are a very conservative, risk averse type of a person, then you're that kind of person is not going to like a HELOC there because the HELOC, like I said, in most cases it is tied to the prime rate, and what that means it's a variable rate, so that interest rate can go up and down while you have that line of credit in place up there. So you have to be comfortable with that, and then you also have to be comfortable with, um, I guess, what you're investing in up there. So if you utilize that HELOC as a down payment on an investment property,
mm.
is it cash flowing to a point to where you're making money on it and you're comfortable with that?
So you have to get to that point where you're okay with your choice.
And that's exactly right.
Mm. Okay.
So, and that's such a personal question there. I mean, you know I can provide some information on that as far as what the rates might be, what the payments might look like, and that kind of a thing. But again,
Now, can we have like a scenario? Let's hypothetically give us a scenario and just break that down so we have an idea.
yeah. So if you just say utilize a HELOC for the 20% down payment.
Mhm.
Okay, so then that HELOC is going to have a monthly payment attached to it. One thing I will say is most HELOCs, there will be a period of time to where you are allowed to make an interest only payment on that line of credit. So that is generally a nice low payment. Even if it is you know interest rate in the eights or nines.
Mhm.
There, you're not having to make a fully amortizing payment there, but of course that comes at a price because you're paying the interest as it accrues every month, but you're not paying anything down on that loan
Hmm.
at all. So now what you have to do is you have to weigh that against buying an investment property. So you use that 20% and you go buy an investment property and you're renting out that investment property. What kind of money, what kind of cash flow are you getting from that investment property? And does it make sense? Is it paying for everything? Is it cash flowing? Are you making money every month? There, because obviously the goal is not to lose money. The goal is
Mhm.
to make money.
Mhm. So when we say make money, what kind of um what would make sense in terms of, especially in this market with the way the rates are high, how much would make sense once all the bills are paid, the mortgage is paid, the um what's it called, property tax is paid, HOA is paid, all of that. What will make sense? What's that difference that will make sense?
That's another question where it's going to be very personal to each individual
Mhm.
answering that. So I will say that it's important that if you are going to buy an investment property, you're going to have renters in there. You have to make sure that you're in a position to be able to do that there because now as a landlord you're going to have legal obligations. So if the air conditioning unit goes out on your primary home, you can choose to fix it or not fix it. You can live with the hot weather
Mm,
if you want to, but for an investment property, if you have renters in there as a landlord,
mm,
you might be legally mandated to make that repair. So you have to make sure you're in a position to do that. You have to make sure you have adequate funds or reserves in the bank to be able to absorb that. So uh, that's one thing to take into consideration. So I'm kind of, going around a little bit here, but, as far as an investment making sense, clearly you want, at a minimum, it has to pay for itself.
Yeah, so people.
They're at an absolute minimum. I mean, don't buy an investment property if you're going to lose money every month. It's, I guess there might be circumstances where you could do certain write-offs tax-wise and that kind of a thing. But again, is that really why you're doing that?
So to make sense, at least it has to pay for itself.
At a minimum. I mean, me personally, I tend to be a little more on the conservative side. I would need to see it cash flow at least reasonably decently. I mean, I would want to see some money going into the bank every month.
A minimum of like how much would make you comfortable?
For me, I don't really, I'm sure there's an industry standard on that, and I'm not sure what it would be. I mean, I would want to see probably at least 20% personally there, but again, it would depend upon your overall profile and your tolerance for the risk involved with it. That's kind of what that boils down to.
All right. Okay. So I will let you take it away. Let me see if we have any question in the chat. I don't see any so far. So please tell us. Okay. How do loans without a credit score work?
Oh, okay. Okay. Yeah. I see reference to, yes, because Dave Ramsey endorses Churchill Mortgage.
Okay.
There. So so there are the no score loans, and as Dave talks about, that's you can get a mortgage without a credit score. So when we call that, I guess you could call it a manual underwrite, is what it boils down to.
Yeah,
so obviously there's a lot of misunderstanding around that. So if you have a credit score, you have a credit score. We can't do a manual underwrite because you have a bad credit score. You have to literally have zero credit score, meaning you do not have any debt, and you haven't for a very long time. So that's literally is a zero credit score on that. And then under those circumstances, then basically what we do, what a manual underwrite means, is that we will take and verify that you have paid your rent, for example, on time for the last 12 consecutive months. We would need to document that you did that. And that can be done in different ways, canceled checks and so on like that. We can also utilize your utility bills, water, gas, electric. We can utilize those and document that you have paid those on time for the last 12 consecutive months. So we would need, the rent plus two or three, or sometimes four additional, what we call non-traditional credit trade lines. There, where you're paying those on time. So that's kind of how that manual underwriting process works, and that's how we come to that.
Okay. And is that common today in this market?
It is. Oh yes, it is. As you know, Dave Ramsey has a very large following, and that's definitely we do a lot of no score type loans on a very regular basis. Yes. I mean, it's not the majority of them, but we do quite a few of them. It is definitely out there.
Okay. All right. So I'll let you tell us more about this and what you had written down that you wanted to share with us today. So the floor is yours.
There. So let's see here. The one thing, if we kind of circle back to the investment properties there. So it is very important that you understand exactly what your legal obligations are as a landlord. I did kind of touch on that before. So when it comes to things like repairs and different things like that, that's very important. If you happen to get a not so good tenant who's not paying on time and stuff like that, it can be very difficult to get them out of that property. There is not something that happens automatic, and every state has different laws along those lines. So you need to make sure you are very, very familiar with how that works there. And that's where the having proper reserves comes into play. If you do get a bad renter in there and they're not paying on time or not paying at all there, or at least inconsistently, do you have the wherewithal to ride that while you take the necessary legal or civil actions to get them out of there and get another renter in there.
So is that usually a concern when someone wants to buy an investment property?
Yeah, well, it's something that you have to keep in mind. Unfortunately, there are a lot of people that do that.
Mm.
There, or maybe you get a renter in there, and to no fault of their own, an illness happens or something happens within their family that, and now all of a sudden they can't make that rent payment like they promised to. So it may not be just because they're, being less than honest or truthful about things. It could be that life happens, as we all know, life happens
Mm. Mm.
up there. But that's where if you don't want to have a rental property, and then just because somebody's not paying the rent on time means you can't pay the mortgage because you're still obligated to pay that mortgage, and then you find yourself in trouble that way. That's not good. So that's where I say you would want to make sure you completely understand your obligations as a landlord, and and have the wherewithal or the reserves in place to be able to do what needed to be done, even if something bad did happen.
Okay. All right, go on. I have a question here on my phone, but I'll let you go on.
There. So yeah. So another, I guess, aspect of the having a rental property would be to please make sure that you're properly insured. Talk to a good, preferably commercial insurance person that is knowledgeable about that kind of a thing, so that they can help you to understand what kind of coverages that might be available out there. And just make sure you're properly insured, and you understand as a landlord that you can protect yourself as well, and in more ways than one. That's kind of where I wanted to go with that. Is just you don't want to take it lightly. It can be being a landlord is a very serious thing because people are now depending upon you.
Wow. Okay. And can you have that with your typical, like your mortgage insurance? Can you tie your investment property with your mortgage? Sorry, with your primary residence, like insure both of them together? Would that make sense?
And oh yeah. I'm sure you probably could. It's going to that would depend upon the insurance company that you had,
Mm.
of course, there. And sometimes you might be better off exploring kind of a more like a commercial insurance policy,
I see.
especially on the liability end of things, because it's a little bit different than, because it's not a primary residence anymore. It's kind of like a business. It also depends, how do you have it set up? Do you own it outright, or do you own it with other people?
Mm.
Or do you own it? Does it, however you have that set up
Mm.
there, you would want to make sure you had all the protections that you could in place, or at least understood what that was.
Good. All right. One question that I have here before you go on is, so considering that, let's say hypothetically, someone takes equity out of their home and intend to go and buy a land in one of those other states where you're licensed.
For land, so we the only land loan that Churchill Mortgage has is basically it's tied to a construction to perm loan. So the only way I can do a land loan through Churchill Mortgage is if you build on it within the next year.
So Churchill will also be the lender for building it, right?
Exactly. So you would have to build on it within the next 12 months there. And if you don't plan on doing that, then what I would do is connect you with one of my banking partners in my network to where you can get a land loan that is exactly that. It's just a land loan with no strings attached.
Okay, so guys, you can hear that. So you can use your equity in your current home, invest it in that land that you see in one of those states, but you have to be able to build within a year. Is what he's saying now.
Exactly. So yeah. At least as far as the land loan that Churchill Mortgage has, that's how we operate as of right now. Those things are always changing, but that's it.
Is that the same with if they want to pick out a good property in another state? Say, okay, I want to buy a house in another state. Like we rightly said that if you have a child going to college, you can buy in that college area and have the child live in the house. So can people kind of take out of their leverage on the equity they have on their home, go buy in Missouri, for example, if you have a child going to school there, and Churchill Mortgage will be able to handle that, take care of that mortgage process. Is that feasible?
Yeah, absolutely. So basically, what you're saying is you utilize the equity in your current home, for example, with a HELOC.
Mm-hmm.
You use that as the down payment to buy an investment property in that town where your child is going to
Yes,
school.
yes, in another state,
Absolutely,
completely different from, say, you're in Tennessee or Texas, wherever.
absolutely.
Absolutely. Okay. All right. So
You bet. That's actually, it's not uncommon at all. So again, it just depends on your overall situation and how comfortable you are with doing that kind of thing.
thank you so much, Mr. Ham. It is 1:30. Oh my goodness, time has
Time
gone.
flies.
Well, guys, I wish we can keep Mr. Ham for longer, but you have his phone number on the screen, his email address as well. Please feel free to reach out to Mr. Ham if you have questions or need clarification on anything is discussed today.
Happy to help.
Yes, I'm sure he's going to be there. He's
Thank you.
very good with communication, so I'm sure he would take care of you as per that. But other than that, thank you, Mr. Ham. Thank you for coming, and thank you guys for
Thank
joining.
you.
And we'll see you later. All right, sir.
Thank you, Timmy.
You're welcome, sir. Bye.